Good evening, everybody. Thank you for making the time. I believe this is the last talk in this year's Spark series, in this autumn's Spark series. And without much ado, I'm Beni Chugh. I work with Dwara Research. Specifically, I'm working with Future of Finance Initiative. The objective of Future of Finance Initiative is to look at the rapid digitization of financial services and examine it for implications for consumer protection as well as financial stability. Core to our work in the last 2-3 years has been the understanding, has been to arrive at a closer understanding of the modularization and disintermediation in banking, the democratization of financial value chains, which basically means the entry of many non-financial institutions into the value chain of financial services. In that context, I'm actually going to first go on a rant trip because this paper took about 2 years for me to complete, and there is a small reason why it took the time that it took. So basically my talk today is structured around 4 heads. First, what was the research question at the beginning of time T0 that we were interested in? Then the length that we had to go to answer that research question over the course of a year and a half. Then the findings, of course, of the study, and then some of the emerging implications. To take a step back, today's talk is dedicated to understanding what are the new kinds of consumer-facing fintech activities which are currently prevalent in India, and what is the financial sector regulation applicable to each type. Now, there has been a veritable explosion of interest in fintech, and this room is no stranger to that. So, I mean, if you look at the Google trends, you'll see 2013 onwards, there's been a surge in the number of times the word fintech is used around the world. Every other quarter, it beats its own popularity, becoming the most popular term all over again. Similar euphoria is also seen on the side of investments, where if private estimates are to be believed, then Medici tells us that $1.83 billion US dollars of investment happened just around last year in Indian fintech. And the similar euphoria is also shared by regulators who are now keen to understand what fintech really means for the existing financial ecosystem as well as for consumers, and how they can best posture themselves to deal with it. And therefore, we have seen that across the 4 financial regulators, there is a need, almost an urgency, to try new tools of regulation. For instance, the regulatory sandbox, which were actually kind of offered by, which are being offered by all financial sectors as of today. So with all of this euphoria, there are many views about what fintech is, but it also appears that there is very little clue about what fintech is. So about 2 years back, we were consistently being faced with the question that how is India regulating fintech? We were at a loss of an answer, but we were dedicated to find one. And therefore we thought, okay, let's set on a journey of how is India regulating fintech. Very soon we realized that actually to be able to answer that question, we need to first understand what is fintech. And that was the most muddled part of the study, because there are each stakeholder arrives at fintech from a different entry point. So for instance, some see it as an industry which is supporting the financial industry, and this industry is technologically intensive. Other scholars see fintech as technologically enabled financial solutions, but not necessarily an industry. And then the third kind of set of people actually say that adoption of technology is not new to finance, and they don't even see what is the big deal about calling it fintech, because finance has been one of the leaders in adoption of technology, and this appears to be just one more wave of technological adoption in finance. Therefore, once that understanding does not prevail or continues to evade you, it is very hard to identify what is fintech and what are the types of fintech that are currently operating in the country. So to be able to do any justice to the first question, how is fintech regulated in India, we had to most definitely answer the 3 following sub-questions. What is fintech? What are the types of fintech activities being offered in India? And what is the extent of financial regulation applicable to each type of fintech activity, and this is the scope of this study. So for the last year and a half, what we have done is we've done extensive desk research to understand A, what does fintech mean, B, which are the kinds of activities that we see in India, and to limit the scope of that study, we're limiting ourselves to just consumer-facing fintechs, and I'll elaborate more in the next slides on that. And then third, again, a desk research on what is the extent of financial regulation. The third one also posed a bit of a challenge because as we know that financial regulation is not uniform across sectors. The way IRDA might regulate some entity or activity might be very different from the regulatory posture that the RBI takes, and therefore there was some problem of comparing regulations by different regulators, for which we ended up creating a very simple indicator. The idea was to keep it as simple as we can without losing generalizations, and that indicator has basically allowed us to convert the qualitative regulatory side afforded to each activity by every regulator into a numeric score, and that's what we'll see throughout this presentation now. So my first question, I'll quickly go over the methodology. I'll not belabor this audience with methodology much, but I'll be very happy to answer any questions that you might have. So just to understand what is fintech, once we understood that there is actually no commonly observed definition of fintech, we undertook a systematic literature review of all the literature, academic as well as regulatory, and then when there was dearth of both, also literature from consultancies to understand how they define fintech or how they arrive at fintech. This flowchart basically captures the databases that we use, Google Scholar and Ideas Repec, and then the total records which were left after removing duplicates, which was 52, and then we screened 52 records and we saw which ones actually dealt with theoretical underpinnings of fintech, etc., and that left us with 24 records. And we would think that after going around the globe on the backs of Ideas Repec and Google Scholar and examining these 24 pieces of literature, we would have some idea about fintech, but the only clear idea about fintech that we got from this literature survey was it is yet hard to define. There is still no clear understanding of what people mean when they say fintech, and therefore because we were still committed to understanding the regulatory posture towards fintech, we hung our hat on this definition by the Financial Stability Board. The Financial Stability Board, and evidently it's a very broad definition, came up with this definition of fintech, which basically means that almost anything and everything could qualify as fintech. If I were to take you through this definition, fintech is technologically enabled financial innovation that could result in new business models, applications, processes, products, services with an associated material effect on financial markets and institutions and the provision of financial services. Now, few challenges that emerge from this kind of a framing of fintech is, how do you define what threshold does a technology have to cross to go from being a technology to becoming fintech? That is not clear. How do you distinguish between an ATM? Is an ATM any less of a fintech than, let's say, a digital payment mechanism? And those kinds of fine nuances are still hard to find, and this is the best guess that we have there. So what we have done in the study is we've tried to qualify material to some extent. We've hung our hat literally on the word materiality, and the way I have defined or qualified materiality in the study is that this materiality should definitely not include gains made from technological advancements. So any efficiency gains that happen because technology is getting smarter or better, or new technology is being applied to same old processes, should not get counted as fintech. Instead, what should get counted as fintech is if a technological innovation is able to unlock a new pathway to access a financial function. So if I'm able to actually access, let's say, a new way of making payments, a new way of taking loans, a new way of getting insurance, of doing insurance, through the application of technology, then that should be actually qualified as fintech, and any other gains in efficiency just due to advancements in technology actually be led as that efficiency gains made due to advancement in technology. Now, I am very aware that this is not an objective criteria. It has so many limitations, but in the absence of another framework, I've applied that lens to look at all the kinds of activities, processes, business models that are being couched as fintech today. And then I've literally used this litmus test saying, have they actually made accessing new function of finance possible or not, and then included them in the typology of fintech. That process is inductive and iterative. So we went through literature. To understand what were the kinds of fintech activities that were currently prevalent in the country. Again, it was a systematic literature review, and this flowchart, this schema, again, the kind of records that we ended up choosing. And this led us to actually, if I can skip a few slides, this led us to create this schema of 14 types of fintech activities currently active in the country. I'll come back to them later. Few things about this schema is the attempt here has been to remain consistent with the functions of finance. Therefore, each color actually represents a different function of finance, and the typology is rooted in the functions of finance, but it looks at technology-intensive models of doing so. I'll come to the schema in a while, but once I had the schema, the other big question was, okay, now I have 14 types of players, activities, entities, whatever you want to call them, and they are most likely, most of them are under the purview of some regulator, some financial sector regulator. Some of them are not. How do you compare the disparate regulatory treatment being afforded to each when the regulatory toolkit across the regulators is not uniform anyway? And to help us deal with that problem, what we've done is we've created a very simple indicator of regulatory oversight, if I can just be a little mobile. So what we've really done is we've taken three very, if I can say, primary aspects of what regulatory oversight should ever include. Whenever you say the word regulatory oversight, the first question that comes to mind is there a regulator involved, yes or no? And that might seem quite, I don't know, that might seem quite insignificant when you take the institutional approach to regulation, but in the realm of fintech this becomes quite important because of their technological intensive nature and not a direct financial nature. It's hard to qualify which regulator has jurisdiction over which service provider, right, or which activity actually. So identification of regulator itself became the first limb of the indicator. This is basically a binary choice. Either you have a regulator or you don't. In the cases that you have a regulator, you get a score of 1. In the cases there is no direct regulatory, the regulatory perimeter is unclear, you get a score of 0. The second limb of this indicator is existence of active regulation. Now what does that mean? Now because our regulatory posture has been somewhat guided, and we can debate the merits of that decision itself, but because it has been guided by an institutional approach to regulation, what happens is that if a provider is actually providing a fintech product, they might automatically fall in the purview of a regulator, for instance InsurTech. So there could be providers who are using wearables, IoT, telematics, etc., to provide personalized insurance products. Now because most of them are already insurance providers, they fall under the purview of the IRDA. However, that particular function of InsurTech may not be intentionally regulated by IRDA. And this is what this parameter tries to differentiate between, that you might automatically fall under the purview of a regulator and therefore you get a 1 on the previous head, but is that regulator taking active steps to regulate the new kind of product or service or function of finance that you're offering? Now this is not a very clear, this is again a bit murky because some of these developments are very new, and most of the times we'll see that regulators themselves need to deliberate upon the regulatory stance, and therefore it's not really a yes-no answer. If there is an active regulation, you get a 2. However, if you're in the process of deliberations, including draft regulations, you get a score of 1. And if you are not regulating at all, then you get a score of 0. And then the third limb of this indicator is degree of regulatory oversight, which means that, okay, you have a regulator or not perhaps, and you have an active regulation or not. What is the degree of regulatory oversight? Are you reporting to the regulator? Is there a paid up capital? Is there some kind of conduct regulation that's guiding you? Or if it's a little more loose regulatory regime where perhaps you're being regulated by an SRO, or it's it's a code of conduct that's guiding you, etc., etc. And based on the extent of regulatory oversight, you get a score of 2, which is the highest that you can get if there is a direct reporting, tight disclosure requirements, etc. And if there is an indirect regulation through a supervisor, you get a 1, and if you're regulated at all, you get 0. Now, before I move on, I just want to say that this indicator was only constructed to compare across regulations. It is not to say that an activity which gets a score of 5, which is the highest that you can get under this framework, is regulated well. A higher score does not reflect efficacy, effectiveness, appropriateness, proportionality of regulation at all. What it just says, what it only reflects is the level of engagement that a regulator has had with that fintech activity and no more. And the merits of that engagement, if that engagement is worth the state capacity, if the risks are being mitigated sufficiently, adequately, etc., should happen. I mean, that discussion should happen, and perhaps this is the first step of sparking that discussion. But this is not a reflection of saying that yes, the posture is great, or 5 means you don't need a change in regulatory posture. It only shows the level of engagement that a regulator has had. Now, the carpentry behind us, we can quickly come to the interesting parts of the paper. So what did we find in about a year and a half? In about a year and a half, what we found is that there are nearly 14 fintech, and this is where I would actually like the views of the room as well. If there are other activities that I'm missing out on, or if there is some kind of mischaracterization, etc., etc., that will be super helpful. But from my analysis, what I found is that there are 14 types of fintech activities that are currently prevalent in the country. Like I was saying before, all of these different bars show a different function of finance. So for instance, insurance, web aggregator, and tech-based insurance providers, which are also called insurtechs, here in the beige are 1 and 2. Payment service solutions is a second kind of function, and then the third, this bigger basket that we see here, is the credit function. And within credit, we are seeing developments like P2p lending platforms. I mean, that's no news to this room. P2p lending platforms are actually intermediaries, are technological intermediaries. They match borrowers and lenders. However, by design of regulation, they are not allowed to retain any of the exposure on their balance sheets. Then we have alternative lenders. Now, what are alternative lenders? Alternative lenders are basically regulated institutions, say NBFCs, but they are predominantly using algorithmic credit assessment using alternative data. So their model is that perhaps people who would not have made it to in the folds of traditional formal finance, they might get loans here. When we say things like thin file consumers, they might be eligible here. So on the front end, there is a regulated entity, usually in the character of an NBFC, and on the back end, the credit worthiness assessments are actually spearheaded by alternative data and algorithmic assessments. Alternative credit risk modelers. Now, it's just a spin-off of the previous category. In the previous category, the modeler and the NBFC are integrated. However, there are also standalone alternative credit risk modelers, which basically analyze the rich digital footprint that users tend to generate in this extremely digitized economy, including social media footprint, your browser history, and several other non-traditional parameters to come up with an assessment of credit risk, and their alternative credit risk modelers. Credit product comparators, which is basically nothing but it allows you to compare the interest rates, etc., etc., terms of different credit cards, different loan products, all in one place. They don't themselves give out loans. However, they connect you to the lending, to the underwriting institution. Then credit product enablers. This is quite a unique category. I wouldn't call it unique because it's quite popular across other jurisdictions, but maybe newer in India, where the concept of credit score is not very well entrenched. So for instance, in jurisdictions like US, the concept of credit score is very well understood, and therefore you have fintechs like Credit Karma who help you improve your credit score and increase your credit worthiness. We are seeing similar organizations come up in India, which basically help people with low credit scores and poor credit history. They look into, they do expense management for them, cash flow management for them, but also like recommend them on how to improve their credit histories, and in some cases also provide them personalized loan suggestions, like connecting them to the underwriting institutions. So these are the kind of developments that we're seeing in consumer-facing fintech in the credit space. And similarly, in the capital space, the kind of developments include crowdfunding. Now, crowdfunding would be a breed similar to P2p platforms in that they are also technological platforms. What they do is that they match retail investors with people / organizations / projects desirous of capital, right? So for instance, you could actually I could actually go and say, I want to release a paper, I don't have enough money, please donate for my cause. And if the paper is good, God alone knows, there is a chance that you could get money. So what I'm trying to say is that the aspect of equity crowdfunding has been a bit marred ever since it came in. So SEBI has not been very clearly articulating its stance on equity crowdfunding ever since 2014. But definitely crowdfunding for like charity, for projects of personal interest, etc., is out there and is happening at a good scale. So that's the first kind of development that we see in the investment market. The second kind of development that we see in the investment market is providers of robo-advisory. Now, advice has always been a business of investment, has always been an integral part of the investment business. Now, what providers of robo-advisory are doing, they're again going that algorithmic ML route, and they're taking information from the user, sometimes directly. For instance, what are your goals, why do you need to save, how much do you earn, etc., but also tapping in on a lot of passive data. For instance, are you a Mac user, are you this, are you that, are you a smoker, etc., to come up with an advice. Now, the interesting thing here is one would ask that why does this qualify as fintech, because human advice was anyway happening. Now, here's the interesting thing. Emerging evidence, and I should say it's more theoretical than evidence-based for now, but emerging theory suggests that what the use of algorithms, etc., has done is that it has made investment advisory viable for people at very low level incomes as well. So that business, that value was not available to them earlier. However, with reduction in costs, this has made actually robo-advisory possible across income levels. Now, the other interesting thing here is that there are two kinds of entities that are engaging in this business primarily. One is SEBI registered investment advisors, or the RIAs, and the other is mutual fund distributors. We'll go a little bit into nuance here itself. The reason that I call out these two entities is because the regulatory perimeter that they fall within are very different. RIAs are under the direct regulation of SEBI, of course, while MFDs are regulated via AMFI. And what that also means is that RIAs have stricter conduct regulations that apply on them. They have to act in fiduciary capacities, etc. However, the business model as well as the obligations for MFDs are quite different. Now, both of them appear to match products and like investment solutions and people. However, the way it seems that they're approaching is a little different. MFDs appear to be only ranking investment solutions, let's say on the basis of performance in the past years, or elements such as tax saving, etc., and therefore they may not fully qualify as advisors because they're not looking into the risk profile of the person who is wanting to invest. But RIAs, on the other hand, they provide full-fledged personalized investment advisory looking into the risk profile of the person, which makes them an advisor. But what that also means is that for a consumer, it is very hard to distinguish between an RIA and an MFD. Like when I visit one of the websites, I wouldn't know if this person is an MFD or an RIA, and therefore the consumer protection regime that I am actually signing into. However, because the services that are being offered are so similar, however, there is this back-end problem that the regulatory perimeter is murkier for MFDs and stronger for RIAs. The other kind of developments that are happening are mutual funds direct plan aggregator. Now, they allow the purchase of direct plans. Of course, this was SEBI regulation way back in in this decade, I think. So this comes from SEBI regulations that you're supposed to offer, for the more discerning investor, you're supposed to offer direct plans. They have lower expense ratios. They do not come with the added costs of commissions, etc. But now what is happening is that you have aggregator platforms which can actually allow you to buy those plans directly with more seamless interface. Then the penultimate is hybrid platforms. Now what hybrid platforms do, and the reason that they also prop up on this chart is, even when seemingly there is little financial function that they're performing, is that they provide an integrated to the user. So you could potentially look at an insurance solution, you could potentially look at an investment solution, and you could look at a credit solution, all in the same website. Of course, the backends will take you to their respective providers, but this kind of a disintermediation and also this kind of a dilution of the institutional divisions that we've had in finance means that a consumer can actually make decisions in a more modular manner. It empowers the user to have everything at a go and then pick and choose the solutions that they want, and that's the advantage of hybrid platforms. The last is, of course, cryptocurrency based service providers. If yesterday's indications of the Supreme Court are an indication, then we'll have more clarity on the regulatory posture, which will be afforded to these guys by September 25th, I think. But currently, cryptocurrency-based service providers, the universe itself comprises of 4 entities. The first one being, of course, the payments systems themselves, the cryptocurrency payment system. The second one being the wallets, where you can actually store cryptocurrency and then, of course, use it and spend it the way you like it. Then the third one being the miners, who are basically the coders who mine that currency. And then there are cryptocurrency exchanges which allow for exchange. The business model there seems to be that there is a differential in the price at which currency is purchased and sold, and that markup is basically the business model. For wallets, of course, in cases that are physical wallets, the business model is quite straightforward. The physical wallet comes for a price and you can actually store your key in there. For software wallets, there are different kinds of business models which also include upselling of different financial products. So this is literally, according to my understanding, the universe of consumer-facing fintech providers in the country. I'm going to pause, and if the room thinks that there are models which should be here but aren't, or vice versa, I'm taking comments at this point.
Where does wallets fit in on the payment services?
Yes, actually great question. So now wallets, etc., so they could either be propped on a UPI interface or an IMPS interface. Now those channels, it's very hard to say why they should qualify themselves as fintech, because you've had NEFT, you've had RTGS, etc. Of course the frequency of that is different, and I see the convenience part of it, but I don't see how that is making a new, it's more about channel. But what I do consider here are payment processors. Because what payment processors have allowed us to do is use almost like a credit function in the payment, because they make using credit card possible remotely, and that has an added utility. However, and it has not been an easy call to take, because the PSSA 2007 does not really define payment service providers, and the draft PSSA 2018 does. But if I were to go by that definition, then any instruction that allows you to initiate a payment, to aggregate a payment, everything is a payment service provider. So I think payments has been the hardest for me as well to qualify, and if I find better reasoning, I'm definitely open to including wallets. So now that exercise is behind us, and we know what is the universe almost of consumer-facing fintech looks like in the country, the next big question was, how is it regulated? And this was a difficult exercise also, because the regulations are continuously evolving. Like we've had to update this paper almost on a weekly basis, because there were changes that ADA was doing. There were draft guidelines on InsurTech that were coming out. We were waiting for the SC's decision on on RBI stance on cryptocurrency, etc., etc. So this has been a very moving space, and I'm sure that some of the information that I'm going to give today might have been outdated, but it's as recent as I can vouch for. So insurance web aggregators. So basically here I've organized them in the descending order. The most tightly regulated ones, or the most closely regulated ones, are at the top, and then we go on to the unregulated ones, which basically get a score of 0. Again, this is not a reflection of what the regulatory posture should be or what the order of regulation should be. It is just a reflection of how it is being regulated currently. So this is not a commentary on this is a great way and this is effective and therefore you should do it. This is just a commentary on what exists right now. And again, the scores are literally just rankings. A 5 is not better than a 4. That is a wholly different exercise where you have to see the risks that each of these pose and then the regulatory tools that you've deployed to mitigate those risks. So quickly, insurance web aggregators are actually quite tightly regulated because they have an entire regulation dedicated to them. Their paid up capital, their conduct requirements, then their revenue models, what they can, what they can't do when they're presenting the different options, etc., are very closely spelled out by ADA. And therefore, of course, there is a regulator, there is an active regulation, and then there are very tight disclosure requirements. Excuse me. And then there are very tight disclosure requirements, giving this one a score of 5. However, one could ask potentially that why does a platform need to have paid up capital? I'm not saying if they should or if they shouldn't, but this is just to impress upon the point that this is not in any way saying that it's a good job. It's just saying that these are the requirements and therefore this is the score. The second one is P2p Lending Platforms. Of course, they have been very tightly regulated as well, and that regulation has been subject to quite a lot of debate as well when it came in its time. Then payment service providers. Now, basically, payments ends up being the most tightly regulated function in the country. So anybody who's so even the UPI, IMPS, and even if we come to NPCI level of oversight, even when NPCI, which is just a consortium of banks and is definitely not a regulator, even when it rolls out its products, you will see that some of the requirements, for instance, membership of UPI, some of the technical details when you'll go in, all of them require sub-licenses from the RBI. Right? And even payments processors, although they were industry regulated until now, there is an increasing indication by the RBI that the RBI is inclining towards regulating payments processors as well. Alternative lenders. Now this is where now we see that how disintermediation is basically playing out in the regulatory sense really. So alternative lenders, to the extent that they are regulated institutions, for instance NBFCs, they are just regulated as NBFCs. The underwriting process per se is choice of a business model and is not regulated, and therefore there is a score of 3 because you're really not regulating, again not for good or for bad, but you're really not regulating the algorithmic alternative data driven underwriting process, but what you're really regulating is the institution, which is the NBFC. Then the next one is providers of robo-advisory. Yeah, providers of robo-advisory. Now this one we've discussed earlier in detail. So here they get a score of 3 because even though SEBI is a regulator, SEBI only directly regulates RIAs, the registered investment advisors, and MFDs are not, the mutual fund distributors are not directly regulated. Therefore, and also there is no active regulation for robo-advisory. So the guidelines from SEBI say that if you're using any tools or algorithms to make an investment advice, then the entity that is deploying those tools will be held accountable. However, we don't know what that accountability mechanism really looks like, if they are audited, if they are exposed to some certain tests. So we don't know any of that. So there is no active regulation really in the cases of robo-advisors. And then of course the extent of regulatory oversight again gets 1, because only till the time you're an RIA, SEBI has some direct levers over you. The moment you are a mutual fund distributor, SEBI does not have direct levers, and therefore the score is 3. Then mutual funds direct plan aggregator, again similar story. The ones that I am really interested in are alternative credit risk modelers. Actually, I want to kind of tease out the credit bucket a little bit more, because what we are seeing is, because of disintermediation, the same process of credit can pan out through different permutations and combinations of services and processes, right? So, I mean, different entities can actually end up performing the same function, but to a very different consequence to the end user. For instance, if I come to alternative credit risk modelers, then alternative credit risk modelers, because underwriting per se is not regulated in the country, that activity itself is not regulated. So what they do is that whichever is the front end regulated institution, the bank or the NBFC, the entire credit risk is actually transposed to that entity, and it's a very contractual kind of agreement between the bank and the modeler. On the other hand, if I look at the P2p lending platforms, which are quite tightly regulated, they also perform a similar function. They also do not take any credit risk, even though they generate one, and they are able to successfully pass it on to an institutional lender, a person like myself who's interested in lending on that P2p lending platform. So what is happening is that the same function of credit is being provided, however the consequences and the incidence of risk, so even though they're all creating the same credit risk, the incidence of that risk varies quite significantly, and this is because the pathway that they've chosen to provide that function is different. So hybrid platforms are not regulated, credit product comparators are not regulated, they get a score of 0, which is in stark contrast with, let's say, insurance web aggregators, when both of them essentially perform the same function of aggregating products and letting the user choose whichever they want to. One is not regulated at all, and the other is extremely tightly regulated and props up straight at the top. So we see this kind of discontinuities across the table, but the three big points that come from the table is, if I look at it, most new fintech activities are converging towards platform economies. So that looks like to be a dominant model, that there is a move to become a platform. Now, the interesting thing about a platform economy is that it has network effects. That means that every new participant actually enjoys an increasing marginal return. So there is a lot more value generated as the number of participants on the platform keep increasing. The other nuance that comes out from this table is that increasing modularization implies that function may be formed through different combinations of entities and processes, which we just saw in the case of, let's say, credit. And the third is that institution-based approach to regulation is actually causing regulatory arbitrage, and that's quite clear when we see that similar risks, for instance, in insurance web aggregators and credit product comparators, are being dealt very differently. So this is basically the big finding. If I had to provide a snapshot of this study, then this is the big finding, which is, this is the regulatory framework for data-driven fintech financial services currently in the country. Arranged from 5 to 0, we see that this is the universe of consumer-facing activities, and this is how they are regulated. 5, of course, being the most tightly regulated, and 0 being the least regulated. I'll be very interested if we have questions at this point. Okay, I hope the samosas are nice. Cool. So if that is the status right now, what does it mean for regulator? Our initial starting point was, how is fintech regulated in India? And loosely this does the job of explaining how is consumer facing fintech currently regulated in the country. But this table also leaves us with a lot more questions than the questions that it answers. And the first one is, what implications does it have for financial regulation? From the table, one thing is clear, that you really need to, the financial regulator can no longer resort to financial regulatory tools of prudential regulation or conduct regulation alone. As we see that there is a tendency for financial services to use more and more data and to converge towards platform economies, there is also a need for the financial regulator to equip itself with corresponding and befitting regulatory tools. For instance, in the case of platform economies, what can happen is that a platform could become too big too soon, and traditionally the way financial regulators have really handled systemic importance is either you siphon off, you disconnect it you kind of ring fence it from and you reduce the connections to other players, or you increase prudential capital. However, if we apply the same kind of learnings here in the case of platform economies, then restricting their connections would actually bring down the value that those platforms are generating, because by definition they have network effects, and every new person actually increases the value of the platform itself and the value that other participants leverage from it. So that option really doesn't work. And then again, prudential capital options will also not work, for instance, in the case of a cyber threat. Right? And no amount of money can actually make do the loss of data, which is now being recognized as a systemic risk in the financial ecosystem. Therefore, there is a need to kind of revisit the kind of regulatory tools that the financial regulators have in their arsenal for now. And we think just from that table, it looks like those tools need to draw from the learnings of the competition regulator, also from the learnings of the competition regulator, as well as from the learnings of the data protection regulator. So tools like interoperability, tools like non-discrimination on platforms. For instance, if a dominant platform chooses not to advertise P2p lending platform, and if I am a lender on the P2p lending platform, then the kind of regulations that I have today are that my exposure can't be more than 10 lakhs and those kind of blanket regulations. What that means is that my money up till 10 lakhs is more or less unsecured. It's really on the basis of how nice or how well or how sharp the underwriting processes of the platform are, right? But actually the credit risk rests solely on me. Now there is a way that, and therefore the prudential regulation aspect, the 10 lakh, the blanket ban kind of regulatory tool is not able to get to the heart of the problem, which is protecting me, a little less discerning lender, from any failures in the future. One way is that these people, and if I were to actually contrast it with, let's say, alternative credit risk modelers, they also generate same risk and they're passing it on to, let's say, an NBFC or another regulated institution. And so basically for a regulator, it's the same breed of risk, which is the credit risk. However, the person who is bearing it in the first instance is a person like myself, and therefore consumer protection becomes a policy imperative there. But the entity which is bearing it in the case of an alternative credit risk modeler is an institution which is free to take the business risks that it wants to take, as long as it has sufficient provisioning, well-functioning contracts, etc., etc. So applying the same kind of tool to both these cases, just because the risk is similar, might not get us the desired end state of affairs, right? There may be a suitability, a reverse suitability kind of assessment, that I as a lender, how much exposure can I take, or as a borrower, is this borrower really worth, so doing those kind of assessments in the P2P case might be more beneficial than, let's say, a 10 lakh rupee blanket ban, which also not only just distorts the market because it's a blanket ban, but it also does little to get into the needs of the lender or the borrower, right? So what I'm trying to say is that we're still using old tools to deal with like newer problems, because the person or the entity who is actually bearing the risk has changed quite significantly. So my table actually leaves us with these two questions, that if this is what is happening, which is like modularization of finance is happening, which means that same services can be provided by different processes and different entities. And if the nature of risk, even though it remains same, it affects the participants in the markets very differently, then how is it that the financial regulators should react? So this is really not an affirmative statement. It's almost like an intent for future research, that from that table it appears to be that these are the two emerging concerns for financial sector regulators, and this is where we should be expending our energies probing these two questions and finding solutions to them. And that's my piece. Questions?